Good morning, everyone watching live on BAM YouTube. Let me know in the comments which market you are tuning in live from. The hot sheet covers what you need to know about the real estate industry in a 24-hour time period. On today's hot sheet, I will discuss a shift in inventory patterns, First Citizens' purchase of SVB, Black Knight's appraisal alternative, and Zillow web traffic. Today is Monday, March 27, 2023. I am Byron Lazine, and the hot sheet starts now. Glad to be back in the home studio here in Naples, Florida today. Be here all week as we close out quarter one and the month of March. Hit the thumbs up if you are ready to launch into this show as well as quarter two of 2023. Please consider sharing this hot sheet with someone who would like a 24-hour look back on all things related to housing. We do this show every single day that the market and bond markets are open Monday through Friday at 9:30 a.m. Eastern, which of course would be 6:30 a.m. Pacific time. Let's jump into inventory. It's been a topic every single week. As you can imagine, inventory makes up a large part of what happens with housing, and we have a pattern shift just in the last week. So last week we saw that we increased active inventory by a number of 1,734. If you were with me last Monday, we spoke about this here on the hot sheet off of the housing market tracker from Housing Wire. We increased 1,734. We thought that was a good signal. Maybe we are bottoming out on active inventory. Active inventory is just homes that are available on the market, not the NAR inventory measurement, which takes active listings and those that are under contract and have yet to close. Okay, so actives up 1,700 last week. Well, this past week, that number was almost entirely erased. Active listings are down 1,109 this week. So we likely have not hit our bottom. Going down again this last week. It's been a trend that we've seen far too often this year. But the big pattern shift is new listing data took a turn for the better. Okay, so new listing data is still down significantly year over year, but up considerably last week. Okay, so the week prior we're at 42,000 plus, and this last week we check in at 50,800 on new listing data. This is a huge number and one that signals better things potentially to come. Okay, all of the charts that we share here will be down below, as well as all the links to all of our sources. You can see here, according to Altos Research, the inventory chart, the active inventory, which continues to go down and has yet to find its bottom this year after having that slight increase last week. If we look at where we were this time last year, we saw a 6,000 increase in active inventory last year from March 18th to March 25th of 2022. The bottom, of course, for 2022 is far off of where we are today at 240,000. Weekly inventory this week fell from the 414,000 and change to 413,000 and change. Still a lot more inventory than last year, but still near all-time lows as it relates to active inventory this time of year. Here's the big jump in new listing. If you're watching, you can see on the screen a sharp bounce up from a bottoming of 42,000 last week, up over 50,000 on new listings here this week. Again, according to Altos Research, but well off of 2022 and 2021 numbers on new listings. Hopefully this last 7 days is a signal that we'll continue to see new listings come on to the market. If you've been following on the hot sheet, you know that I've argued we need more new listings because some of the inventory that's been hanging around might be either priced well above where the majority of home shoppers can afford a home, or it might just be junk, right? It might not be something that a starter home buyer can go in and purchase because it needs to be completely torn down, it needs a ton of work, or it's just completely out of line with where the market sits today. This accumulative inventory, which we don't have much of it, but what we do have, I would question, and I'd love to see somebody do some data, some research, some analysis on this stuff that's been hanging around. And you could do it in your own MLS. Let me know if you have in the comments. I was on Jeremy Knight's show, and we did like a little bit of this where we went through like 3 or 4 examples on the Austin MLS where it's like, okay, we've got inventory rising, but look at this shoebox, which doesn't even have windows and is listed for $150,000. It's a lot, but it's listed as, single family homes. So I don't know if you're seeing something similar in your market, but in order for us to actually get some of this inventory back that people can buy, we need this number to continue to go up. And I like this pattern shift a lot for the real estate market, for the spring market, that we saw this bounce up from the bottom of 42,000. We're still way off of anywhere we've been over the last 6 years. 2022, we were at 62,000 this week. 2021, we were at 60,000. And in 2017, 16, and 15, 79,000, 76,000, and 108,000 respectively. So well off of new listing data in comparison to these past 5 years, but a strong bounce up and hopefully a sign of good things to come as we continue to move forward. In last week's existing home sales report from NAR, which we covered here, we also saw that their number remains unchanged for inventory. Now they go off of active listings as well as properties that are under contract. So they're continuing to report 980,000, which is well off of the 2 to 2.5 million number that we need to get to. And I do have all of these charts here down below, the inventory, the new listings chart, and then this one here, which tracks NAR's inventory number. Okay. This number here, if we were going to just draw a line at where we are historically between 2 to 2.5 million of inventory calculated by NAR, okay, we would see a line, if you're watching, that goes like this. Okay, right across the screen, going all the way back into the 1980s. You can see here, really since 2016, this triangle has created a crater of lack of inventory. We're down below 1 million homes. We still have 1 million more homes of inventory to go before we get anything close to historic normal levels. And this is, again, is active listings as well as the under contract listings. That's how NAR calculates it. Okay. If you look at even the run up to 2008, you saw well above that even well above 2.5 million active listings, really at no time from the 1980s until, I don't know, 2016, 17, really a little bit before 16, 17, you had some seasonality jumps in here. But into the 2010s for sure, did you jump below that 2 million mark? You had a brief moment here in the 90s. Okay. So anyone that, believes we're just going to have this plummeting in pricing, we don't have enough inventory to plummet the prices. That would be, especially with the absorption, right? We saw new listings go up this week, 8,000, in a week that we saw total active inventory go down 1,700. We were expecting active inventory to go up. That tells you when there is a good quality home close to the median price point, that absorption is high, right? And let me know in the comments if you're seeing that type of absorption in your market. One thing all of the markets have been looking at very closely is what's happening with the banks. And today we saw some new information on the banking crisis. First Citizens has soared more than 40% in pre-market trading after buying over the weekend a large chunk of the failed Silicon Valley Bank. The deal will see First Citizens Bank purchase around $72 billion of SVB assets at a discount of $16.5 billion. Quite the discount. A further $90 billion in securities and other assets will remain in receivership for disposition by the FDIC. The First Citizens CEO was on CNBC this morning, and he used the phrase "we" a couple times when talking about First Citizens Bank and the FDIC. That caught my attention because it means that they are in unison. It's almost like they are partners, right? They're buying a chunk of the bank, a significant chunk for sure, but a large chunk of the bank is also staying with the FDIC. Okay, so this is going to put, while the market seems to be reacting well, stock market, I believe, like they certainly like it for First Citizens. I mean, these bank stocks lately have been a day trader's dream, the way that they've just been bouncing up and down, over 25% today in that, or over 40% rather today on that First Citizens deal. All right, S&P is flat. Where's the Dow? Why are we not seeing the Dow? Okay, Dow's up big. Dow's up 200 points. S&P is basically, actually S&P's up 0.5%. Nasdaq's up a little bit. All right, so the stock market's reacting to this. They must like this. I think it puts a little bit more pressure on the FDIC. They've got a little bit more responsibility here. And we know that there's a lot of thoughts around, hey, we want the FDIC to insure all depositors. I don't see how they can do that, but it does signal that there is a little bit more confidence in the markets. We also saw over the weekend that there was a report that less transfers from regional banks to the big four at the end of the week were happening. So maybe there is some more confidence out there. That would be good for the economy overall. The U.S. Federal Deposit Insurance Corporation transferred all SVB deposits and assets. So they took over all the deposits for Citizens into a new bridge bank earlier this month in an effort to protect depositors of the failed lender. Now, as of Monday morning, First Citizens will be open for those depositors. Okay, so again, their stock jumped up 40%. Market seems to like this, and we'll see what happens as we move forward. Hopefully, we can go a week without any turmoil in the banking industry. From one government bank to another, Fannie Mae approves Black Knight to support new home valuation option. This is on nowbam.com. Black Knight is one of only 6 vendors approved by Fannie Mae to support their new valuation option, value acceptance plus property data. Using Scout, Black Knight's property inspection application, appraisers and other approved data collectors can collect interior and exterior property data using a mobile service. Okay, so they're officially now one of only 6 vendors currently approved by Fannie Mae to support their new home valuation option. Fannie Mae announced the new option on March 1st as an alternative to traditional appraisals in updates to its selling guide. The value acceptance plus property data valuation option allows for properly trained and vetted third parties to collect interior and exterior data on property under consideration. I believe you'll continue to see products like this roll out to ease up the appraisal process. We talked about Plunk on here, or certainly on the Real Word in a past podcast, on what they're doing to kind of change how valuations in the industry are done. Lender appraisal management companies, AMCs, and other industry professionals can use Scout, Black Knight's mobile property application inspection app, to easily collect data as part of the value acceptance plus property data process. Okay, so if we continues in this direction where appraisals become easier and it doesn't impact the valuations when banks are lending, right? We already know that mortgages are going to tighten up a little bit right now, meaning there's not going to be that much liquidity into the mortgage market as there was in the past few years. We don't want to see valuations get out of control on the loans that they are lending on, because that would, create some bad loans on that segment of the market. So hopefully these numbers continue to be accurate. And if they do, banks will be more likely to use it. Fannie Mae will approve more banks to be able to do this, and we'll see a quicker process for buyers buying homes. And maybe even more, as technology takes over, technology always typically will reduce costs over time. So if technology can become more of the appraisal process, hopefully it reduces costs and allows for a faster process. I know that appraisers would argue that this is opening up the door for bad appraisals. The president of Black Knight Data and Analytics says, "We are honored to be one of the small group of providers approved by Fannie Mae for lenders to use for the data collection process as part of the value acceptance plus property data option. Scout is a great option to support Fannie Mae's appraisal modernization initiative. By using Scout, lenders experience significant efficiencies and cost savings, as well as greater data transparency, minimize the potential for bias, and realize faster origination turn times." It's Ben Grabowski, president of Black Knight Data and Analytics. I like how he said bias in his quote. Potential bias. I've been one to point that out in the appraisal industry for a long, long time. And I've had a lot of appraisers just think that I'm insane for saying it. But if this government-backed president of Black Knight Data, Ben Grabowski, says it's true, then it must be true. So way to go, Ben. Thanks for validating the thoughts I've had for many years. One thing that's been going on for many years is the Zillow domination of web traffic. Inman reports that Zillow now accounts for nearly half of all real estate web traffic. This is according to analysis from SimilarWeb, digital intelligence platform, SimilarWeb. Okay, so Zillow continues to dominate the market share for real estate web traffic in the US, but other companies, notably CoStar's Homes.com, more on that in just a second, are making sizable gains, even as traffic to real estate portals declined overall amid market uncertainty, according to this new analysis released earlier in the week, last week. Search behemoth Zillow far and away led market share for real estate search portals between February 22 and February 2023, gobbling up 44% of market share for real estate web traffic, according to the digital intelligence platform SimilarWeb that I just mentioned. Realtor.com followed with 19%. So basically, you've got 64% according to this analysis from Zillow and Realtor.com, while Redfin boasted the third highest at 15%. So SimilarWeb says that 2 out of 3 buyers are using Zillow. Well, Zillow, in their earnings report, which we covered here recently, we covered their quarter 4 earnings report, have always argued that they already control 2 out of 3 buyers on the web. This is Zillow's earnings report that was just we just covered last month in February. Okay, if you see here, roughly 65% of mobile app users for real estate marketplaces are using Zillow's app. Okay, so they've long mentioned or stated that they are well above 50%. SimilarWeb is saying that it's just about 50%. Love to see Zillow come out maybe this week and either address that or validate it, one of the two. Yeah, we've shown this chart after their last earnings report, year-over-year monthly unique user growth. Top 15 real estate companies combined, excluding Zillow Group, is in the yellow. They lost 8% on year-over-year monthly unique user growth, while Zillow Group year-over-year was up 1%. And this report here that was in Inman talks about overall web traffic being down 5%. So while overall web traffic is down 5%, Zillow, according to their data, continues to grow. I do think it's interesting here, if you're following along, the residential power players here, residential web traffic power players, that CoStar had a sizable jump. CoStar has been rumored to buy Realtor.com, which would put them in the driver's seat to compete with Zillow. They've also been rumored to continue other acquisitions. They've stated themselves that they're going to make a big acquisition this year, that they had a big jump with Homes.com. Okay, so only 3 of 17 websites tracked year-over-year increases, and they're saying Homes.com, Remax, and Compass, so they're not giving Zillow what Zillow states in their earnings report. I'd love Zillow to come out and dispute this. So homes.com, one of the three, according to this research, that increased web traffic, increasing 86% year over year. There's a crazy article Ray Ellen wrote on nowbam.com where homes.com is stealing agents' name and likeness and using it in YouTube ads. Okay, we're going to cover it on the Real Word this week in depth, but basically there's screenshots. If you want to go read the article now on nowbam.com, homes.com is running ads on YouTube that has an agent's name and location. You click on it and it goes right to homes.com. It's fascinating. We're going to go deep on it on the Real Word podcast tomorrow, which premieres every Tuesday at 2 p.m. But CoStar and Andy Florence, they're very, very aggressive. So I'm not surprised that that report came out. And I'm certainly not surprised that homes.com, since the acquisition of CoStar year over year, is up 86% on web traffic. They're going to be aggressive in their fight to take over some of this residential web traffic. Okay, so we'll see. We'll see if Zillow responds to this. According to this analysis, they're drawing 44% of all real estate web traffic. Zillow certainly's number is well over 50%. If you take this number on this report, Zillow and Realtor.com would make up 2 out of 3 buyers using one of those two portals in their online search. So real estate agents might be a cue to look closely at Zillow and Realtor.com if you care about home shoppers, because 2 out of 3 are using those two sources. Let's take a look at our 10-year using the source of Wall Street Journal. 10 years back up over 3.5 today. We know we need to track the 10-year if we want to see where the 30-year fixed is going. It appears that the 30-year fixed today probably will jump up over where it closed the week last week, as we're up over 3.5 on the 10-year. We can't seem to get below 3.4 at any given point for any type of sustainability on that 10-year. And we closed out the week last week on the 30-year fix at 6.38. We had some stability the end of the week, Wednesday, Thursday, Friday, 645, 644, and 638 on the 30-year fix. We may get back up to 6.5 or right around there, just based on where the 10-year is trending this morning. Later this morning, we have an Overask podcast at 11 a.m. with Derek Gregory on content struggles. If you're following Derek on Instagram, you do not want to miss that podcast. And then tomorrow, we have a webinar that I am going to be hosting with Formations. Formations is a service that make taxes suck less. Okay, never overpay on taxes again. Formations is the predictive tax management solution for the self-employed and specifically real estate agents. I'll be doing a webinar with them tomorrow. Last call for everything you need to know before that April tax deadline, which is looming. So if you need to get educated on what you're doing with your taxes for this April deadline, do not miss that webinar. There's a sign up down below. I'll be hosting that tomorrow with Formations. All right. Hope you enjoyed this episode of the Hot Sheet. If you did, please consider sharing it with one person who would like a look on housing in a 24-hour time period. Please subscribe so you don't ever miss an episode. And until tomorrow, toodaloo.